Hi guys, I'm so excited for today's video because we are going to take a look at the efficient market hypothesis. And this is absolutely something that everyone investing in the stock market should know about. And when I first learned this was such a revelation to me. So today you're going to learn what this hypothesis says and what it implies to us small investors if true. So let's dive right into it. In his 1973 best-selling book, A Random Walk Down Wall Street, Professor Burton Malkiel claimed that a blindfolded monkey throwing darts at a newspaper financial pages could select a portfolio that would do just as well as one carefully selected by experts. And indeed, this has since been validated. Not by using actually dart-throwing monkeys, of course, but through using simulations of dart-throwing monkeys or random stock pickers. So how can a group of dart-throwing monkeys that pick stocks randomly build a portfolio that does just as good as experts, or humans for that matter, who are using lots of time to analyze companies and historic stock data? Are stocks moving more randomly than many think? And we're going to begin in the 1950s when computers were first applied to economics. And maybe not too surprising, the first use of computers was to study time series, namely historic stock data. To find a possible advantage that could generate money was of course a huge driving force. The expectancy was to find clear patterns in the historic stock data that could be used to predict which stocks were going to perform better and which were going to perform worse in the future. If it was known beforehand which stocks would rise, one would of course buy these stocks and make lots of money. But to everyone's surprise, it wasn't possible to find any patterns that could predict the future stock prices. And this might seem illogical at first, but I'm going to explain to you why this instead is a sign of a well-functioning and efficient market. So if you think this seems a bit illogical, let's do the following thought experiment. Let's turn this around instead and imagine that they did find clear patterns in the historic stock data that could be used to predict the future stock prices, based on the current price and information available about the stock that is currently known. As soon as these patterns or signs appeared that predicted the future price of the stock would rise, everyone would of course buy the stock now, or equally sell the stocks that showed sign of falling future prices. So far it seems logical, but if we take this one step further, it will be apparent that it's not sustainable. Imagine that we have a stock that is now priced at $100, and now we see the sign in the data that predicts that the stock will rise to $110 in the next few days. So everyone that sees the sign and predicts that the stock price will rise in the coming days will of course try to buy the stock today at the lower price to gain those $10. But the ones that already own the stock today, they can also see the signs of the upcoming higher price. So they would of course not sell today at 100 if they knew that the stock will be worth 110 in just a few days from now. Efficiently, this means that the price of the stock would rise already today to 110, as the market factors in the good news of the signs about the upcoming price increase. Now, this seems pretty logical, right? If we generalize this, all information that can be used to predict the future value of a stock should already be priced in and reflected to the stock price today. As soon as some new information emerges that suggests that the stock is undervalued, buyers are going to flock to the stock and the prices should move to a more fair level. And as we cannot predict when new information is going to come or if the information is going to be good or bad, it's not possible to predict the future price of a stock according to this hypothesis. That is called the efficient market hypothesis. And this is one of the most central ideas surrounding the stock market that you should understand to be able to make more well-educated decisions about your future investments. So what does this all mean for us investors? Well, if this hypothesis is true, then all information available right now should already be priced in. At the lowest level, or if the market is only weakly efficient, then technical analysis, where investors study the historic stock charts and use patterns there to try to predict the future stock prices, should not work. And I will return to this in more detail in an upcoming video, so subscribe to not miss out on this. And I would really appreciate if you could also then just gently smash the like button. This all falls down to how accessible the information is, and historic stock charts is one of the most accessible sources of information about the stock out there. Therefore, it's very likely that the buy signal that you see in the chart has also been seen by others and then has already been priced in. That is, if you're not the first one to see the signal and buy before everyone else. But how likely is that really? If the market is semi-efficient, then fundamental analysis, where one study, for example, the key figures such as the PE ratio or the accountings of a firm, should not work. This is also information that's pretty easy to access for everyone. Maybe you have to make a little bit more of an effort than just to look at historic stock prices, but the information is for sure something that professional analysts look at first of all. So if there would be any information in the fundamentals that could predict the future stock prices, then someone else would already have acted on this information, and the current price would already reflect this and be fairly priced according to the information available. If the market is 100% efficient, then there should not be any information at all that can be used to predict the future stock prices. And this means that there shouldn't be any inside information, for example, that could be beneficial to act on. But we do know that inside information exists. However, the market doesn't have to be 100% efficient to affect us. Rather, it's about realizing, especially for us small investors, how easy it is to access the information that you have and how much you can also gain from acting on this information. That is, if you think that you can find any information that no one else knows about, that can give you a real possibility of predicting the future stock price and buy it now when it's cheap before anyone else realizes this. Different markets are probably at different efficiency levels. For example, the US stock market is probably the most analyzed stock market in the world, and it's likely then that this market is more efficient than the markets in, for example, an emerging market country. And large cap market is likely more efficient than the small cap market, as there are more analysts following large cap companies. So there's probably a possibility of finding some new information that no one else knows in all markets. But where there are more professional analysts, the possibilities are likely less. The question is if you were able to find this information, or if it's more likely that a professional analyst with much greater resources would find this first. And we're not talking about the information you can gather by looking at the latest reports or stock charts, because it's 100% sure that you're not the only one that have done this. The information has to be much harder to obtain to give you an edge. There are examples of firms that specialize in selling such information to portfolio managers. There are firms that use satellites to monitor how many cars that are parked outside of big retailers, like Walmart for example, to estimate if sales are going up or down. Or there is an example of a firm that measured pings from phones inside one of Tesla's factories and could then predict that the capacity had been increased when more pings could be measured on the night shift. More pings meant more people working during the night, which meant that the production had been ramped up. And sure enough, not long after this came an official statement from Tesla confirming this, and the course jumped by 9%. This is the level of information that you need. Information that no one else has. So if you don't have your own satellites or surveillance equipment, maybe it's not so likely that you and I, small investors, will find any information that is not already known by the market. But why are there then people that succeed to find these gem stocks and beat the stock market? Well, statistically, there will always be someone at any given time point that will succeed in doing this, but very few, if any, succeed doing this long term. And the ones we see in media are of course the ones that succeed. But we never see that many more that fail. And it's very hard to know if the success was due to skills or just luck. It's sort of like that we know that it's bad to smoke, but still it's possible to find these 100-year-olds that have smoked most of their lives and are still alive. But this doesn't prove that smoking is good, right? So what does this all mean? Well, different markets are at different levels of efficiency, but they are all probably efficient enough so that especially us small investors don't stand a chance of finding any information that no one else knows and thus is not already priced in. In this case, it's more of a gamble to pick your own stocks, so make sure that you choose a good amount of stocks so that you increase the possibility of picking one of these few high performers that I talked about in this video. In the short run, it seems like the market is not totally efficient. For example, we can see overreactions to news. But in the long run, the stock price will approach what the market perceives as the fair value. What does this not mean? It doesn't mean that the stock prices are always correct. The price merely reflects all known information that is available right now. But what this information conveys about the future stock price can sometimes be wrong, which leads to mispricings, and sometimes it's very wrong. Look at the dot-com bubble, for example. Everyone thought that internet and the telecom business would have a much greater immediate impact than what it turned out to have. And then, when this became apparent, the stock prices were corrected, mildly speaking. Effectively, this also means that if you find a good system for investing that really gives you an advantage, don't tell anyone, because when everyone else knows, the system will be ruined. Question of the day: would you like to get your own dart-throwing monkey, or would you rather stick with a professional investor? I bet the monkeys are much cheaper though. Guys, subscribe for more videos about personal finance and how the stock market really works. Thank you so much for watching all the way to the end, and see you all next time.